morning, everyone. Welcome to another Vototalk. It's a pleasure to moderate the event today with you. We're going to talk about the ESG era this morning. Very hot topic, very interesting topic around the world. We'll have the presence of Amélia Miazad talking with us from Berkeley University. I will present her in a few minutes, as well as Jeane Tsutsui, the CEO of Fleury Group in Brazil, joining us as well in this morning. It's actually an honor to be able to host this event and moderate in the name of Vototalks Group, which we can say it's a reference in ESG, both nationally and globally. Even before the ESG acronym was created, the group has decades of work being done in consonance with sustainability practices. So it's a real honor to be able to moderate this panel this morning with you guys today. I will quickly explain how we're going to work. We will start with a keynote session from Amélia in a couple of minutes. This will take around 45 minutes. Then we will have around 40 minutes of Q&A. I'll try to shoot some questions to Amélia and Jeane as well, and we'll have on the chat of the event the ability for you guys as well to send some questions that we will try to cover throughout the event. So thanks so much again for the presence, and without further delays, let me introduce Amélia Miazad. Amélia, thanks so much for being here with us today. Amélia is an expert in sustainability, what we call sustainable capitalism, and found and leads the Business and Society Institute at Berkeley Law University. The Institute's mission is to define and advance a legal and policy agenda that encourages companies to account for stakeholders and the environment. Amélia teaches several courses at Berkeley Law. In addition, also, Amélia has designed and teaches several executive education courses for C-suite executives around the world and board members as well. Amelia's recent publication explore stakeholder governance and ESG as a process for overseeing risk and a powerful tool for transforming corporate culture. So, Amélia, thanks so much for being here with us this morning, and we are really keen to hear your session.
Thank you so much for this terrific opportunity and for the invitation. I'm extremely excited to talk about this increasingly urgent, really, topic of ESG and stakeholder governance. I view it from the perspective of risk oversight. So let's get started. So we will be today on a journey together, and I often attempt for the journey to feel like this, okay? But it's ESG, it's a rapidly evolving area, it's changing all the time, and so at times it may look a little bit like this. So here's a map. The map today will have 3 points. The first point is simply defining ESG, and believe me, I teach semester-long classes just on what is ESG. So we're going to cover it today at a very high level to help contextualize what it is and also to distinguish it from CSR, corporate purpose, and stakeholder governance. After point 1 on the map, we will go to point 2, which is really to understand the growing focus on ESG. And what my work looks at is investors. Investors are driving this phenomenon, and although stakeholders are looking at companies to address their environmental and social externalities, the momentum is being driven by investors. So we'll examine that. And then we will examine why precisely investors are looking at ESG as a proxy for sound risk oversight. What insights does that process provide for boards and for management? Okay, so let's go to point 1 on the map, defining ESG. So ESG, first of all, what does it stand for? Of course, it's environmental, social, and governance, right? We all know that. However, the challenge is that these 3 small letters, environmental, social, and governance, really cover such a wide range of issues. You'll see it covers things like environmental issues such as plastic straws and plastic pollution, which is indeed a crisis, and board diversity, or diversity in the CEO and the C-suite and more broadly. Now, these 2 things seemingly have very little in common, right? Environmental issues and these social issues. So the mandate of ESG is actually quite broad. It's also conflated and confused with many, many different topics and many different labels, as you will see on this slide, from corporate social responsibility to corporate sustainability to a new one that former Chief Justice of the Delaware Supreme Court coined EESG, with one E being for employees, because he feels that that is not focused on enough in the traditional ESG paradigm. So we have a lot of labels and we have a lot of letters, and it feels sometimes like a black hole. Okay. I look at ESG as a process as opposed to a discrete number of issue areas, broad issue areas. It is a process, and really the G is quite different from the E and the S. ESG is about governing environmental and social risks. Increasingly, it is all about how ESG helps to flag risks, identify red flags for the board and for management. Now, the interesting thing about the risk landscape is that landscape, as you all know, much far better than as academics like me know, it's getting more complex. Your day-to-day jobs demonstrate that to you time and again. And it's also becoming more interconnected. And this is important because of what I will discuss later about the investor focus. So, on the one hand, investors want the companies in their portfolios, and stakeholders want the companies that they work in and that they buy from to address environmental issues. One example is a company's individual carbon footprint. It also, these stakeholders and investors also want companies to address systemic or systematic risks. Now, there's a lot of confusion as to what is a systemic risk and what is a systematic risk. So let me just briefly pause to describe the difference between the two. A systemic risk is something that society bears, such as climate change, such as income inequality. It's something that the entire economy and indeed the entire society bears the externalities of. Those systemic risks are described as systematic risks when they affect financial portfolios of investors. So from the lens of an investor, these are systematic risks to the investor's entire portfolio. The actual risks are the same, but whether they're described as on a societal level or a portfolio level is a distinction between systemic and systematic. And of course, these terms are often confused. Now, another example, an example of a social risk is living wage to workers of that portfolio company. That becomes a systematic risk or a systemic risk when it's broader throughout industries and there's income inequality. Okay, so what individual companies do and how they manage their externalities ends up causing these systemic and economy-wide risks. Now, that is why investors are increasingly focused on these, as we'll discuss. But to understand this present moment, this very unique present moment that we are at today, we have to understand a little bit about the past. So once upon a time, there was CSR, corporate social responsibility, and I view that as very distinct. It was a different movement from environmental, social, and governance. And here are some, at a very high level, these differences. Corporate social responsibility was really about philanthropy. It was about doing good things in order to negate the negative externalities. An example might be a company that pollutes in a local environment might then, in order to garner the goodwill of that community, build and fund a school in that community. The school has truly nothing to do with the company's business model, strategy, or risk oversight. It is just a way to enhance the reputation of the school, of the company, because of these negative externalities. That is sort of traditional CSR or corporate social responsibility. Now, some companies use these terms interchangeably, but I caution you to not do so, because CSR connotes a particular orientation, particularly for the investor community. The investor community is interested in ESG. Now, there is limited C-suite and executive engagement traditionally in the CSR movement. And often it was led by a corporate affairs or a public affairs or corporate communications function. We've evolved, and we're evolving even more quickly each day towards ESG, which is importantly linked to long-term value creation. It has broad-based investor support, and there are many examples of this, which we will look at in a moment. Importantly, the ESG movement has board oversight, because the board of directors is ultimately responsible for overseeing business risks and leveraging business opportunities. And so it's important for the board to oversee how ESG is implemented. There's a tone at the top from the CEO and executive management, and it is cross-functional. So you have the legal, risk, compliance, sustainability offices working in concert as opposed to in corporate silos. So, because I'm from Berkeley, the University of California at Berkeley, I must show you a picture of a hippie. Otherwise, the faculty gets very upset at me. But this picture really encapsulates for me the origins of the corporate social responsibility or the sustainable investment movement. It was not about making money. It was about doing good. Okay. Importantly, much of this movement on the investor side comes from faith-based investors, religious investors that are really interested in values over financial value. Now, the Interfaith Center for Corporate Responsibility started this movement essentially to address apartheid in South Africa several decades ago. However, the Interfaith Center for Corporate Responsibility is still very much active today, and the initiatives it adopts is very similar to those that are adopted by the mainstream investor community, but yet the motivations are distinct. This movement is about, at its core, values, whereas the ESG investor movement is, at its core, about long-term, sustainable, durable investor returns and value. So, where are we currently? Currently, there's no hotter area on Wall Street than ESG investing. Now, there's a lot of greenwashing happening here, of course, because, as we'll discuss later, there is an evolution of standard setters, but we are still very much on the journey of how we are going to oversee what is an ESG investment and what is not. And the Securities and Exchange Commission is working very hard on standards to help differentiate for investors and for the general public these where to draw the line. But it is a growing area. So you can see 2 slides here demonstrating the growth of market share for ESG investments since 1975. And the other slide, the principles of responsible investment, have grown tremendously as well. And the principles of responsible investment were really the origins of when the mainstream investor community, so not faith-based investors or values-based investors, but traditional investors, started to make this connection between environmental and social oversight and sustainable financial returns. This is when it started to get mainstream. Okay. So now let's move on to the second point, which is understanding and contextualizing the growing focus on ESG. Why are we seeing the growth that we saw in on the previous slide in the mainstream investor community? So a couple of years ago, 3 years ago, to be precise, somebody said this: indeed, the public expectations of your company have never been greater. Society is demanding that companies, both public and private, serve a social purpose. Now, I like to share this slide with students and then have them guess who would say something like this. Of course, you are experts in the business and investment community and seasoned professionals, likely know the answer to this. But my students assume that it comes from a regulator, or this statement comes from perhaps an academic, a progressive professor, or that it comes from a values-based investor, such as the Interfaith Center for Corporate Responsibility, such as investors that are still very much active and investing based on values. This is a picture of Sister Judy Byron, who's still very active in ICCR and has been for decades. But these are values-based investors. But no, it is coming from people like this. This statement made international headlines a few years ago. It has also raised a lot of questions, more questions than answers, I would say, as to what is meant by serving a social purpose. But this, of course, is Larry Fink, the CEO of BlackRock, the largest asset manager in the world. And so why would the largest asset manager in the world make a statement like this? Companies should serve a social purpose. And what precisely does it mean for corporations to serve a social purpose? As I said, it has raised more questions than answers. And interestingly, we had BlackRock shortly after this statement was made come and do a roundtable with corporate executives at Berkeley Law to really try to parse out, what does this mean and what is the motivation behind it? And importantly, when companies engage with BlackRock, what precisely is BlackRock looking for to substantiate that companies are serving this social purpose? Now, it's not just BlackRock. BlackRock is getting a lot of attention, but it's investors, global investors around the world. The motivation for this is that there's a concentration of capital. In pension funds, in large asset managers, capital is becoming increasingly concentrated. So when investors like BlackRock, make statements like this, they are responding to a perfect storm that is happening in the world. And there are many, many forces at play that is motivating this perfect storm. Some of them are theoretical, in fact. Some of them are just changing theories of corporate purpose. Okay? Also, at the same time, our social norms are evolving very quickly into hard law. So you'll see that we'll have social norms related to forced labor in supply chains, let's say, and jurisdictions around the world are passing legislation to address forced labor in supply chains. And this link between changing norms and hard law is happening far more quickly. So proactive companies are really watching norms as opposed to responding to a law. There's increased legal and regulatory risk. There are many more social movements that are fueled, importantly, by social media. Social media has created a reality where nobody can hide anymore, and the reputational risk is immediate and severe. Another very interesting phenomenon that my work focuses on more recently are weak governments. Weak governments all over the world, including in the US, placing more pressure on companies to address these externalities. Under the traditional paradigm, we look to governments to address issues with employment, issues with environmental pollution, and we look to companies to generate revenues within the bounds of the law. Those lines are blurred today. So let's go to just remind ourselves of the theoretical landscape. Of course, a very influential academic, Milton Friedman, famously said, "The only social responsibility of business is to increase profits." Now, to be fair, Milton's academic literature was more nuanced than that. He conceded that there are ethical limits to corporate behavior, and there were many, many nuances, but nevertheless, Wall Street did not adopt those nuances, and the normative orientation of Milton Friedman's shareholder primacy really has reigned the day in the business and investment community for decades, since really the early 1980s. His timing was, of course, impeccable. The market was not doing very well in the US, and there was an appetite for deregulation, and we had President Reagan in office. And so everything sort of worked out perfectly for this academic theory to have immediate impact in markets. Now, why was this theory so alluring? Well, maximizing shareholder value was, in fact, as the argument goes, good for society. This is good for society. And why? Well, the expectations are clear. For one thing, direct shareholders own companies, directors are their agents, and governments address harms. And the more money that society has, the more money that society has to give through private philanthropy, private donations, and also, importantly, through taxes. Okay, so this was not a argument that said that, maximizing shareholder profits are just good for shareholders. The normative appeal of this argument was also great. Now, there were academics debating this. Of course, there's famous academic Edward Freeman who talked to people like you in industry and said, no, companies cannot sustain themselves if they are shareholder oriented. And you all know this, you have to account for the impacts on employees and stakeholders. But this theory remained really academic until quite recently. There are famous papers written saying shareholder primacy wins the day. We don't even need to debate this anymore. It will take over the global business and investment community. And in fact, it pretty much did exactly that. However, today there is a debate raging, not only in the business world, but also in academia. So this is a debate that I encourage you to listen to if you're interested in this topic, between Colin Mayer, who advises the World Economic Forum on corporate purpose and is very stakeholder oriented, and Professor Lucian Bebchuk at Harvard, who says, no, slow down, everybody. Stakeholder concerns are in conflict often. And if we give too much value to them, we will end up hurting not only shareholders, but also stakeholders. So the shareholder primacy paradigm works. Let's not fix it. So here's just a definition of a prevailing view of corporate purpose today from Colin Mayer. Corporate purpose is the purpose of companies is to solve society's problems profitably and to not profit from causing problems. So there is a profit motive, right? But it has to address and account for society, because there's a social license to operate. As many companies in Brazil in particular know, the local communities have to be a partner in the long-term sustainability of your businesses. And so this social license to operate is increasingly frayed for businesses around the world. So he anchors this corporate purpose to that social license. Now, this debate is not only academic, importantly, this debate is happening in Wall Street and Main Street, in towers of companies all over the world. You may think that this tower looks very similar to one in Chile. It's because it was actually designed by the same architect. But this is our Salesforce Tower in San Francisco. And Salesforce is just a paradigmatic example of a stakeholder-oriented company. And so years ago, this statement was made 6 years ago. I default to this concept of stakeholder theory. So they have to decide between shareholders and stakeholders. And so the general counsel of Salesforce often says, well, no, we don't have to decide. The long-term, our fiduciary duties run to our shareholders, but the long-term sustainability of the company depends on accounting for stakeholders. But in any event, the CEO, Mark Benioff, would say things like this, which is very similar to Edward Freeman, ideas he was expounding in 1994, and earlier ideas in the 50s, really focusing on stakeholders. So we can all say, okay, well, this is just a statement by a CEO. What import or impact does it have? It doesn't matter. There's no accountability. However, Salesforce does embed its stakeholder-oriented view into its corporate governance in very meaningful ways. One early example, is its financial disclosures. So it did not need to do this, but in 2018, Salesforce decided to be transparent about its corporate purpose and how it views its responsibilities to stakeholders, including shareholders, but also including customers, employees, communities, and society. And so this in 2018 was pretty progressive. Now, because the Securities and Exchange Commission is interested in corporate disclosure on environmental and social issues, we're seeing more of these statements. So what motivated this statement from Salesforce in 2018 is interesting. It's the public expectations of companies. Larry Fink's CEO letter came out in 2018, and corporate executives who were internal champions of environmental and social goals, felt emboldened to make changes such as putting these statements in financial disclosures. So even these public statements by investors end up impacting internal corporate governance. Why? Because people follow the money, right? And often to understand what's motivating this change in corporate governance, my research also tries to follow the money and interview investors and large asset managers to try to understand what their motivations are. So part of the motivation, of course, is that systemic risks such as climate change are just simply unsustainable for long-term value creation. Now, we talked about Mark Benioff's statement a few years ago being groundbreaking. It is now the main view of the corporate and community, at least in their public statements. So if you look at, again, Professor Bebchuk, who's highly critical of this stakeholder orientation and these statements by the Business Roundtable, he will say, these are just words. I argue that they're the beginning of a transformation of corporate governance, and they're a reflection of what's happening. Perhaps I acknowledge that it's happening imperfectly, slowly, idiosyncratically at different companies, but I challenge the view that it is just puffery or just statements. Okay. So the phenomenon, as we know, is a global one. The Davos Manifesto also, the World Economic Forum at Davos also last year adopted a stakeholder-oriented approach. And then after this momentum, of course, we were hit with the COVID-19 pandemic, which has really highlighted inequalities, not only inequalities in the US, and the really highlighted how fractured and frayed the economic stability of the global economy is. But it also highlighted a lot of inequalities between and among countries. As we know, with respect to the difficulties that Brazil had, that I was very sad to learn about from students in other classes with respect to vaccination rates. And I understand these inequalities. I was born in Afghanistan. And so COVID-19 really put this, really accentuated already existing economic inequalities, both globally and very, very locally as well. So when COVID-19 came onto the scene a little over about a year and a half ago, the corporate community, a lot of people opined that the corporate community would retreat from ESG and would not invest in this process, this new corporate governance process. But some scholars, including Professor Stavros Gadinis and I, who look at ESG as a process for risk oversight and resilience, said, no, we actually think companies and investors are going to double down on ESG. And so maybe we made some bets, small dollar bets in the corporate, with corporate law academics, who said this is a bull market phenomenon. And we won. Early days, maybe we will lose. Still, I want to express this with a lot of humility because we don't know what's going to happen with the economy, but we are seeing an increased emphasis on ESG and more demands for companies to serve a social purpose. We're seeing investors be far more aggressive in the tactics that they use in their public statements, in their private engagement, in their voting against directors, and in litigation in the US filed against directors and officers for not prioritizing. So we're seeing an increase by the investor community. We saw early reports from industry making this link between sustainable investing and resilience. So this is one very good report by BlackRock. Another one, in the midst of COVID, March 2025, by B of A, saying actually ESG is more critical during a downturn than during rosier periods. So I had a sign, showing all my faculty members that actually, that if it is risk oversight, then it should be better during crisis. That's what the investment community is. That's where they're putting their money on this process. So why? Well, I have a theory as to why, and this theory comes from many discussions and conversations and interviews with these investors and with investor coalitions such as Climate Action 100+. capital is becoming concentrated in fewer and fewer asset managers. So while the tactics of people like BlackRock who say serve a social purpose, has been met with cynicism because here's the largest asset manager on Wall Street, it actually makes financial economic sense for them to prioritize companies that address externalities. Why? Because the markets have changed. And if you think about it, if you are a concentrated owner, if you have shares across the entire economy, you view externalities differently. If Exxon is doing fantastic for its own stock price, it's not, by the way, but imagine that it is doing very well, but the externalities that Exxon is causing on the rest of the economy is making all of your other portfolio companies, a real estate company, let's say, underwater, literally underwater, let's say, both metaphorically and literally. That is not good for you from an economic financial perspective. So some economists and the economists, importantly, that these asset managers look to and employ, understand this portfolio level or systematic risk. But corporate law and corporate governance and many academics are still looking at individual companies. Well, it's not about individual companies. It's about all of us being interconnected. This interconnectedness was really highlighted by COVID-19 as well. You saw that small businesses in your communities could not survive or thrive without large companies, like some who we'll hear from today, addressing their responsibility to the community. We're interconnected. Vaccines could not be distributed without the private sector and the public sector working together to develop, to create, to distribute. So this interconnectedness was highlighted by COVID-19. This focus will remain as we address climate change, I'm hoping, because we can't look at picking winners and losers in an economy that is increasingly interconnected. Okay? So universal, for a theoretical perspective, which is what my work looks at, universal owners or highly concentrated investors, they don't pick winners and losers. They want the entire economy to survive in the long term. Okay. So what does this have to do with ESG? What does this have to do with ESG? Why ESG? Okay, we understand the externalities piece, that these investors are more motivated to address economy-wide impacts. But why do they look to ESG? Well, ESG does two things. On the individual firm level, it helps companies manage individual risks, externalities that the company causes, okay? And it also, I'm from a law school, so risk, but you're in business. Many of you are in business, and you know that so much of it is about the green boxes on this slide as well. That ESG is a way to seize opportunity, particularly given the investor and stakeholder focus. It's a way to attract employees. It's a way to attract consumers. So it's about risk and opportunity. Now, why this risk and opportunity? Well, this insight comes from speaking to and interviewing corporate executives and importantly, on-the-ground sustainability experts who are operationalizing sustainability at a management level and further. What do companies that do this process well, what do they do? It is a highly systematized process. First, there's a cross-functional governance structure. So the information is not in corporate silos. It operates very similar to traditional enterprise risk management. In that information is shared between the CFO, the general counsel, the investor relations team, etc. Companies conduct stakeholder mapping. So they identify and they think about who does our business impact. Now, that stakeholder mapping of course, will benefit stakeholders because the company will assess the impact on stakeholders, but it also benefits the company because it identifies where the risks are, right? I'll give you an example. PepsiCo did a very detailed mapping of its human rights due diligence and its supply chain, in the context of its human rights due diligence process shortly before COVID-19. And it was an extensive stakeholder mapping process. That put them at a competitive advantage during COVID-19 because they had far more information about where the risks in their supply chain were. That enabled them to have business continuity in a way that they would not have been able to have had they not had that information. Their motivation for doing so was, in fact, to address human rights abuses and challenges that are opaque in the supply chain, but the impact was to help them have resilience. Okay. The third step is conducting a materiality assessment and really weighing which stakeholders and which issues will cause the most risk, the most financial risk in particular. Then, with all that information that is importantly obtained from internal and external stakeholders, the company sets goals and KPIs and then continuously manages towards those goals. And finally, reporting and disclosure. Now, reporting and disclosure is often viewed as just an output, right? Just a communication tool. And it's an imperfect communication tool because it's so idiosyncratic. But I view it as a process because to get to that sustainability report, even if you're early on the journey, you have to break down silos and you have to communicate with external stakeholders. And that gives you an informational advantage to be able to assess and respond to risks. So even the reporting and disclosure is not just an output. And I like this slide to describe the ESG process because it's continual and it covers the same ground continually over and over and over again with a number of different eyes. So that is why I reject the notion that you see in headlines and you see in academic papers that ESG is just greenwashing. There's far more accountability built into the ESG process in practice than there is in traditional, let's look at the stock price to determine how a company is doing. Why? Because there's so many more eyes on the information and there's so much more information being surfaced continually. And investors understand that. That is why they're putting their money on ESG. It also builds trust and dialogue with local stakeholders simply by listening to stakeholders, even if you don't act in the end, adopt management in the end decides to go a different way. Simply the act of listening to stakeholders and assessing their concerns builds trust. And that dialogue makes the company more resilient. You'll see in the BlackRock report, Resilience Amid Uncertainty, that is why BlackRock believes that the ESG process or focusing on sustainability makes companies resilient. It's very difficult to measure. State Street is actually trying to measure this with this data tool called the R factor. It's very difficult to measure things like trust and culture, but intuitively we understand that this robust dialogue builds trust. So it breaks down corporate silos and ensures that information flows horizontally and vertically in the firm, but also internally and externally among stakeholders. Why is the disclosure valuable? It flags risks. It communicates internally and externally to a wide number of constituencies. And so what Tim Mohan, the president and CEO of GRI, likes to say is corporate disclosure on sustainability is like a mirror. So even if you take that sustainability report and you throw it in the garbage and nobody ever sees it, it has still been a valuable process because you have, I'm not suggesting that anybody does that, but it has still been a valuable process because it has put a mirror up before you to see where the risks are. Okay, it's just so much more information than the traditional model. So I'm going to spend 2 more minutes. I know I'm a little bit over time, but I will spend 2 more minutes on disclosure because there's so much focus on it, and there's a lot happening in this landscape. There's mandatory disclosure in the US that is by the Securities and Exchange Commission, and Securities and Exchange Commissions around the world are following in similar ways or leading in similar ways. Then I put voluntary disclosure, and I put that in quotes. Why? Well, because when the largest asset manager in the world and your largest investor asks you to disclose using a particular disclosure framework, it's not exactly voluntary. Then there are supplier terms, customer terms, etc. So in addition to public statements, investors are really focused on disclosure and are mandating. So this is, again, BlackRock mandating what disclosure frameworks to use. This is a very new development. Before, investors would just say, disclose what's financially material. Now they've chosen a favorite. They've chosen TCFD, the Task Force for Climate-Related Financial Disclosure, and SASB, the Sustainability Accounting Standards Board. Now they've said you can use GRI, but we want your disclosure to be SASB, TCFD aligned. So you can do a mapping if you choose to do so. Why? Because SASB is designed for investors. It's designed to be financially material. So just the last slide that I'd like to share with you is a slide that really helps me when I get confused about who all the players are in the reporting and disclosure framework. And this slide, which was prepared by an advisor at SASB, brings us from the reporting frameworks, which is TCFD. These are reporting frameworks because they're a high level and they really try to assess how the board and management is overseeing the sustainability goals and targets. To standards. Standards are specific goals or key performance indicators, and SASB and GRI are two of the most common ones. SASB is focused on investors. GRI is broader. It's focused on all stakeholders. Many companies use both. Then there's questionnaires, as many questionnaires, as excuse me, as I'm sure many of you know. Then there's a new development with respect to auditors and consultants. So the big four accounting firms are now auditing sustainability reports, not financial disclosures, and not to the level of rigor. So for the CFOs and financial folks in the audience, it's an assurance level audit. And many companies are using these as a signal to investors that there's rigor and accountability in their sustainability disclosures. Then there's data aggregators and indexes, which are highly, some companies will rate high and low. Tesla is a good example. It rates high on some indexes and low on the on others. And finally, this information is fed to investors and other stakeholders. And I will share these slides so that you have them. I won't go through the SASB slides in any detail, but I will share them. And I will now close for the rest of our program. Thank you so much.
Amelia, thanks so much. So complete and interesting keynote presentations. We have some questions to you later on today, this morning. I will now jump to Jeane Tsutsui. I'd like to introduce Jeane joined the group Fleury in 2001, and since April of this year has assumed the position of CEO with the commitment to lead the company's digital and technological transformation, and with the ambition of building a sustainable health ecosystem in line with the best ESG practices. Fleury has been part of the B3 Corporate Sustainability Index portfolio for 7 consecutive years, and in 2020 became part of the Dow Jones Sustainability Index as well. Throughout the organization, nearly 100-year history, ESG practices have become notable and strategic pillars for building a sustainable health ecosystem. In April 2021, the ESG committee of the group's board of directors was officially created as well. Jeane, thanks so much for being here with us today, and I would love to hear how has been the journey on sustainability and ESG for Fleury Group as well.
Thank you very much, Gabriel, and congratulations, Amelia, for the amazing presentation. I think that I learned a lot and hope that we can also bring some other insights for those who have joined us in this event. And I would also like to thank the Vototalks team for the invitation. For me, it's an honor to share our experience in this issue of ESG at Fleury Group. So just to begin, I think that it is important to mention that the Fleury Group is a 95-year-old company. So we are in the healthcare sector, we are a diagnostic center, and sustainability is expressed in our mission, and it's very much in line with the values of the company. So I think that over the years, we have been working with this ESG, what we call ESG now, but a long time ago, we started about more than 20 years ago, looking at the environmental impacts of our business, because, as I said, we are a diagnostic center company, so we process a lot of samples, blood samples, and our first worry was about the biological waste. So we started with some policies regarding quality and how to decrease the biological waste. And over time, of course, we engaged in other quality issues. For example, for the certification of ISO 9001, and after that also the ISO 14001, so the environmental and quality. And it is important to mention that in this journey, we try to address the cultural aspect of sustainability. So over time, the engagement of all the employees in terms of education, in terms how we can start this movement in terms of to be conscious about the social impact of all our activities, not only social, but also environmental. And in 2007, we created the sustainability area as an initial area, but over time, it is across the company. And since then, we are working with social responsibility with many initiatives, but also the ethics and the social impact of our activities, and of course, governance. So even before our company went public, we did the IPO in 2009, we had a board of directors with independent members, and this was very important. And I also would like to mention that in 2010, we started a broad view in the company, so bringing the sustainability issue to all the company and creating our materiality matrix together with all the stakeholders. And today we have reached the ESG era with the development of this strategy with a very, very robust plan, because what we want now is to increase our level of engagement for the future. You have mentioned, Gabriel, this year we have the ESG committee, and the coordinator is the chairman of the board, and we have more and more inputting this view of how we can embed the ESG in our business model. So I think that we have a very long journey regarding sustainability first and now ESG view. But I would like just to mention that it is important for us 3 points. The first is that ESG is a long-term initiative. So as I mentioned, we have started this more than 20 years ago, and you need to change the mindset, the organizational culture, and this is very important. The second point is, I think that ESG is investing in the relationship with all the stakeholders. So you have to involve the employees, the society, and of course the investor. We are a publicly traded company, but I think that this multidisciplinary view is very important. So you have to involve all the company. And the third point, just to finalize, is that ESG is a strategic issue. So for me, as the CEO and the board of directors, we are all involved in these long-term impacts. So we have the commitment of the top leadership, but also you have to bring all the employees, the physicians, to have this view. And I think that for us, I'm very honored to complete this journey, and because health is a very, very important issue for the society, and how a healthcare company could impact and to offer a better quality health. For me, it's a very, very interesting point, and we are all committed to that. So, Gabriel, just to answer this first question, but I think that we can make more comments in other topics, just to give an initial view of our initiatives. Thank you.
Perfect. Thank you, Jeane. It's interesting to see how I think Amélia framed so well the 6-step journey that the companies are going through on ESG. Just to make an example, in our case in Banco Bovi, we are following exactly that pattern, Amélia. For instance, the balance between risk and opportunity that you mentioned before. We are the leader in Brazil in auto finance, for instance, and we decided to launch a program, actually a unique program in America so far, the first bank to announce a public commitment to compensate pollution emissions from the fleet that we finance. So this on the risk side, if you will. But on the opportunity side, we've also jumped into the solar energy sector, and we have been in the past 3 years the leader on financing the solar energy residential market in Brazil as well. So that balance between risk and opportunity, I think all the companies are really going through. In terms of governance and incentives, Jeane told us about the committee, the involvement of the board, and so on. In our case, it's pretty much the same, but we also linked ESG goals to the variable compensation for the leadership in the bank. And you can imagine how tough was this discussion inside a bank environment, right? So everything around governance and incentives as well. And finally, the need for public commitment and disclosure. I think that that really creates a sustainable focus throughout time, whoever is the executive on board, right? So it becomes a company matters, not a person matter. And in our case, we pretty much did the same. We announced early this year our 2030 public commitments around ESG practices for the bank. And of course, we started to disclose in our financial reports everything that is materiality. There is material around that subject. So it's interesting to see how different companies, different sectors around, of course, different maturity levels around ESG, but they're pretty much following the 6-step journey that you frame, isn't it, Amelia? And with that, I would maybe address a question for you. How do you see? How can we differentiate what is really, a path to maturity around ESG in comparison to what could be framed as greenwashing? How do you, in your experience, see signs of greenwashing whenever you're talking to companies and the broader community?
Yeah, thank you so much, Herbert. And I find that so many of the examples that you shared are really leading and inspiring. So thank you. Well, I think one thing that Jeane said really resonated with me, which is ESG is a long-term initiative, right? So if you are on the journey and you're committed, but you're not there yet, sometimes that looks like greenwashing. So how do you assess? It's very challenging, but there are some indicia that investors look to. So what tools do investors have to assess corporate behavior on ESG or corporate commitment to ESG? Private engagement, right? Disclosure, and then what companies do in response to shareholder proposals if things are not moving. Okay, so on private engagement, this is very hard to assess because it happens behind closed doors. But if the board of directors is not engaged at all on ESG, that is a sign for investors that they're not meaningfully on any journey. An investor will understand if the company says, we are beginning our ESG journey. Here are 3 things we're doing now. Here's where we see ourselves next year. If there's a pandemic, we might take a couple of steps back, but we are on this journey. When the management and the board doesn't know about how ESG is being operationalized, that's a red flag for directors. Okay, and corporate governance can address that through structures like Jeane described, where there's a committee, right? Okay, so that's one thing. Second, committee charters are sometimes indicia that companies are taking ESG seriously. Third is one that you both mentioned, which is tying ESG targets to executive compensation goals. That is very important because it shows that the business strategy is aligned with the ESG commitments. Now, are there ways to manipulate that and greenwash that? Of course, there's ways to manipulate everything. It's not perfect, but it's one indicia. And then the governance structure itself. So I always look at, where does ESG sit in the corporate hierarchy? Is there a direct line of communication to the CEO and the board? What is the CEO saying in their public statements? And how are the different committees at the CEO and the executive management level structured? So I look at it through a governance lens as well. Of course, disclosure provides information to directors about what is greenwashing and what isn't. And the disclosure is getting increasingly standardized because of this investor pressure.
Perfect. Very clear. Jeane, how in Fleury Group throughout this journey you connected ESG principles and the sustainability long-term view with the business itself? What kind of examples could you share with us?
That's a great question, Gabriel. We also have alignment of the ESG initiatives with the variable compensation of the executives. But in terms of what we are doing, we have, for example, many things over time. But now I think that we are looking for how we can really embed the ESG in our business model. I will talk a little bit about some examples. Now we have sustainability linked bonds. This is the first time that Fleury Group, this is our 60th debenture, and it is a sustainability linked bonds. And we have two long-term goals. The first one is our commitment to decrease the biological waste. We started with that long time ago, but we have a clear goal now. In the next 5 years, we have to decrease in 20% our biological waste management. So I think that it is important because we can talk about the decrease, for example, in energy or gas emission, but in terms of what we really do as a diagnostic center, the decrease in biological waste is a big issue. And the second one is how we can increase the access to quality for the Brazilian population. We know that traditionally, Fleury Group, we have been working with the premium and high intermediate segment of the population. And we have a huge challenge in Brazil because only 25% of the total population have access to the healthcare insurance. So we are now starting, and we have the goal for the next 5 years to increase the access to the lower levels. So we are talking about the C, D, and E segments of the society. So we have many initiatives to increase this access. And of course, this sustainability linked bond is linked to address this specifically issue. In terms of how we can talk a little bit about other things. For example, we have many initiatives in our business that came from this ESG view. And we know that this has a huge impact in all the society, our employees, our physicians. In the COVID-19 pandemic, we had lots of initiatives in partnerships with universities, in partnership with the whole society, how we can deal with this big problem of health in this scenario of a pandemic, COVID-19. So I think that over time, we are incorporating many other things, for example, to decrease the emission of carbon, and of course, everybody is very worried about this climate impact. We have, for example, not only looking at how we can use electric cars, for example, for the transportation of our blood samples, but also we are investing in photovoltaic plants to decrease the consumption of energy in our patient centers. We have a total of 250 patient centers in 8 states in Brazil, but we are looking for new renewable energy, for example. So I think that over time, we are very committed to embed this ESG in our business model in general.
Fantastic. And it's interesting because when you have this journey in a very, I would say, meaningful way, initiatives start to pop out throughout the company, isn't it? So in our case, for instance, I was just surprised later last year that we were the first bank to issue the first green bond in local market in Brazil, and this was not on the roadmap. So pretty much the people from Treasury started to think about it and make it happen. Same on the risk side. We already had a very solid risk management approach around the environmental risks and also the governance and social risks around the clients that we serve. But this year we started to look also to the effects of climate change around the rating. So it's interesting when you push the agenda throughout the company, initiatives start to pop out. Amelia, let's talk a little bit about the public sector. We talked a lot about the private sector. How do you see this complementary approach between what companies are doing and also the need for public policies, especially, and this also comes from the audience, especially in a world that is so political polarized these days? How can we get momentum in terms of pushing the right agenda, also on public policies? What have you seen around the world on that matter?
You're asking me from the U.S.?
yeah. It's also polarized political scene right now, right?
And unfortunately, yes. Now, I think there is a recognition in the Biden administration that our largest challenges cannot be solved without partnership with the public-private sector, without public-private sector partnerships. So I'm hopeful that there will be more such partnerships. But where we are seeing progress is in local government and business partnerships. And that, it is not surprising. So I will give you one example of one that I view as very successful. It's another example that comes from Salesforce, where Salesforce actually lobbied to have a local tax in San Francisco that Salesforce and other San Francisco companies pay in order to address the homelessness crisis. Now, the way that Salesforce did this was important because it is important for companies not to usurp the role of government, right? We don't want, because they're not democratically accountable. So we don't want the public policy agenda being dictated by the corporate agenda, which happens, of course, through lobbying, et cetera. But these kinds of partnerships where the resources are and perhaps knowledge is provided, but the agenda is ultimately set by government is happening at the local level. One thing I wanted to say about politicizing these systematic risks is, in some jurisdictions, the health crisis has not been politicized, which is around the world, which is good. So we're seeing collaborations with private industry and government. In the U.S., unfortunately, the COVID-19 pandemic is a political issue. And so those that are advocating for public health are generally Democrats or progressives, and those that are rejecting that as an infringement upon freedom are on the other side of the aisle. So this has created a very unhelpful tension and unhelpful and imposed barriers on our progress to be able to address the pandemic. So some good news and some bad news there.
Sure. We live in a very noisy world these days, right? Jeane, let's talk about diversity. I think it's another aspect of the ESG agenda that is it's also on top priority, I believe, in Fleury Group and several companies around the world. What can you share with us around the diversity issue?
Yes, Gabriel. Well, it's a very, very important issue. First, it is important to say that we are a diverse company. We have a cultural diversity linked to our even geographic distribution. For example, we have patient centers in 8 states in Brazil. So from the northeast, São Luís do Maranhão, until the south of the Brazil, Rio Grande do Sul, and we have a total of 15,000 between employees and physicians working with us. And it's very important to respect and to engage this diversity in our business, because of course we have some things regarding the how we can reduce the reputation risk. So we work a lot with education and also with the code of trust to bring this respect and to have the psychological safety to all the employees and the acceptance of our internal diversity. Another point is regarding, for example, the gender diversity. I would like to emphasize that today we have a report in Valor Econômico regarding the showing some data of the board index from Spencer Stuart, and they are talking about that in Brazil, the total of women on board is around 14%, so it's half of the percentage in United States, for example. Here at Fleury, we have a total, we have 20% of women on board, and we have the recognition of this title of women on board, so we have 20%. Also, when we talk about the executive directors and the executive board that includes the executive directors and me as the CEO, the percentage of women is 43%. That I think that it's a good number. And when we are talking about the total leadership, so as the coordinator above, we have a total of 67% of women. So I think that we have been working over years with this specific topic of women in the leadership, and we are proud. I think that we still have room to increase these percentages, of course, but I think that we are proud of our numbers. But also at Fleury, another interesting point is that we have a total of 74% of women in science, technology, engineering, and mathematics. So STEAM, because of course, the scientific part of our business is very important. But besides the gender diversity, I would like just to remember that we also have many programs to talk about the ethnical, racial, and the gender diversity, and also LGBT, and also the people with disabilities, and also refugees. So we have many things, and I think that the diversity is very important for our business. For example, of course, we have customers with disabilities. We have customers that are transgender. And another example, talking about these groups, about the some other disabilities, we have created a specific services to provide a better care for children with autism in our patient center. So making this combination of a diversity and embed this in the business, like I said before. And just to finalize, I think that diversity is important not only for our business as a healthcare company, but also to bring more innovation and to bring more the ability to have more new ideas and flexibility, because the environmental is changing very quickly, and we have to have more diversity in our teams. And I think that this is a competitive advantage for our company.
Perfect, and it's a topic that has so many subtopics, if you will, and the connection with innovation is clear, and research shows that, right? In our case, for instance, we have been in a digital transformation and innovation journey, and just to share with you, in the past 3 years, around 60% of new employees came from outside the financial sector background. So with that, you can imagine how more diverse we went on discussions and working groups and so on, and having the leadership with a more open mindset to be able also to connect with those new backgrounds, and it's a journey. But as you mentioned, whenever you start to talk about it, whenever you start to look at it in a more profound way, you see several programs that companies can do. We are really proud, for instance, to be able to get back to the working space, mothers that were out of the working space for the maternity, and then were not able to get back to leadership positions. We launched a program this year called The Place of Mothers is on BV, and we had over 3,000 women that applied for the job, and it's unbelievable how really interesting careers were somehow interrupted by maternity, and with all the existing mindset in the market, how difficult it is for those women to get back to the leadership career that they had before. So whenever you start to talk seriously about the subject, so many opportunities arise, right? And I believe it's our job as leaders to really push that conversation within the companies. Amelia, let's talk a little bit about reporting again. We have been suffering here on BV on trying to understand how can we standardize our reports, how can we look to companies in a more comparable way. You showed a slide that has so many new sources and new standards arising around ESG. What can you share with us around that?
Actually, that's a terrific segue to go back to this slide that I didn't get to. If you're looking for comparability between your company and your competitors, and indeed that's what investors are looking for, to compare the different companies in the same industry, I think SASB, the Sustainability Accounting Standards Board, does a terrific job. The reason is it's industry specific. So it looks at the financial issues by industry. And I think that is very helpful because you're comparing apples to apples in that regard. I think that another way to compare and to standardize will come through the auditors, the external auditors. Some of those are traditional auditing firms, the Big Four for the financial and sustainability audits. But there's other mechanisms such as B Labs for benefit corporations. Some companies choose to become benefit corporations and get the certification so they can have that external audit and compare themselves to their sustainability-oriented peers. I think we have a long way to go with reporting and disclosure, but I do think that the pace has accelerated incredibly in the last 3 years. And with the pressure from investors pointing to specific disclosure frameworks and the appetite of the auditors to get into this for business reasons themselves as well, will help standardize this quite quickly.
Thanks so much. Thanks so much. We are reaching the end of the event. We could stay here for hours talking about the subject. Is so interesting. I would like to take the opportunity to give Jeane and then Amélia a couple of minutes for your final remarks. Jeane, how we as leaders can push ESG agenda faster and even further? How do you see that?
Thank you, Gabriel. I think that this is a challenge, but I think that it's important to bring this agenda more and more, and of course, not only as the top leadership, but in all the levels of the company. For example, I think that it's very important to make this connection between our long-term goals with what we do in our everyday practice, how you can connect all the employees in these goals. So for us, for example, it's very important now to bring this social impact to our business. And of course, we have a more ambitious levels now, and we have this ESG committee that bring more specific goals. I think we have to connect these goals with the incentives of all the company. But I think that for me, it's like we said, it is a journey, and we have to keep this in a strategic view, and also every day we have to mention and we have to connect the practice, and as a leader, we have to give the example in everyday practice. But I think that it's very good to see that all the companies, everybody is talking about. Of course, as Amélia mentioned, we have to give this start as an important point for investors because of risk. But this connection with the purpose of our company, for example, is very good. So I'm very happy to share our experience and to learn with you all. And it was a very good event. Thank you very much, Gabriel and Amélia.
Thanks so much, Jeane. It was a pleasure to learn with you as well. Amélia, your final remarks. How we as leaders should push forward this agenda. How do you see?
Yeah, thank you so much, and thank you, Jeane. I found so many of the things that you said really resonated with me and very, very inspiring. So I would start by saying it's important to be proactive because this is coming. You don't want to be reactive because by then the governance structures aren't built and it's too late. So be proactive. But be realistic. It's a journey. So taking the first step is, just a first step, and it's a marathon and not a sprint. I would say, and I got very excited hearing both of your examples, be excited. It is a purpose-driven companies. We didn't spend a lot of time on purpose. Purpose-driven companies are joyful and fulfilling to lead, as Jeane can attest to, and to work at. So be excited. This is a positive transformation, particularly as governments are getting, unfortunately, weaker. Be humble. There will be mistakes made along the way, and those are, again, opportunities to engage stakeholders and learn from those mistakes. My final, so those were kind of, broad brush final comments. I would say that governance matters. I used to say there are no bad people, there is only bad corporate governance. I teach a course called Corporations in Crisis. And if you look at the governance structures, it's very easy to predict that this company or that is going to be in crisis. So governance matters because it forces communication and information through appropriate channels. So I would say if you're starting at the beginning, start with good governance.
Excellent. Thanks so much, Amélia, for sharing your knowledge with us today. And it was a real pleasure. I would like also to thank the audience. It was a fantastic event. I would like to invite you all to the next Vototalks session that will occur on November the 10th with Mr. Adam Grant as the keynote speaker. It's also a very interesting subject, and maybe to end the event, I would like to share a quote with you all that the group Votorantim always tell us as executives and leaders within the group. There's only one way to do business, which is the right way, right? Which is the correct way. The how matters, and we firmly believe in Group Votorantim that the ESG agenda connects with that. So thanks so much, everyone. It was a pleasure to be with you all today. Thanks, Amelia. Thanks, Jeane. Hope to see you soon.
Thanks for the invitation, and thanks for the audience and for Votorantim in facilitating this fantastic and timely discussion.
Thank you very much. Thanks, Votorantim, for the invitation. Thank you.
Thanks so much. Thanks so much. Take care.